If you're trying to stay ahead in biotech, you know the feeling, right? You're just drowning in this sea of data, trial results, regulatory
Oh,
filings,
absolutely. It's information overload by design.
and you're just searching for that one high signal insight.
It's meant to paralyze you, frankly. And that's why we do these deep dives. We take a dense stack of sources, like this Q1 2026 positioning guide from Biomed Nexus, and just pull out the essentials for you. We cut through the noise.
So our mission today is to hand you the playbook for Q1 2026. We're going to extract the big secular themes, identify the 7 high conviction companies, and this is the critical part nailed down, the exact catalysts coming up.
And there's one really monumental shift that the sources are pointing to for 2026, the whole growth at all costs era. That's over.
So what's replacing it?
We're now in what the guide calls the efficiency rotation.
The efficiency rotation. Okay, so that means the market is rewarding actual commercial success, logistics, and I'm guessing supply chain security.
Exactly. Security at all costs is the new mandate. The focus is on the proven, the reliable, and the predictable.
Okay, so let's unpack this. Before we get to the 7 names, why is Q1 2026 such a unique moment?
Well, the timing is fantastic. The sources argue that we're seeing some exceptional risk-reward opportunities because the end of 2025 cleared out these massive uncertainties.
Like what?
Well, you had major policy risks removed with the Trump-Barracks Accord, we'll get into that, and then critical FDA approvals, like for Cytokinetics Mycorrhiza, which is greenlit an immediate launch, and then big M&A like BioMarin buying Amicus.
So the big question marks got answered right before the new year. That really sets the table.
It does. And the analysts didn't just pick 7 stocks at random. There's very specific portfolio structure here.
A disciplined framework.
Absolutely. For you, the listener, the strategy itself is key. It's built for stability. Think 60% core holdings, 30% growth or thematic plays, and then just 10% for those tactical high-risk binary bets.
Let's start with that stable 60% core. This is where we're looking for proven execution, predictable value.
And the highest conviction commercial launch story in the entire stack is Cytokinetics, ticker CYTK.
Right. The thesis here is all about their new drug, Mycorrhiza. It got FDA approval right before Christmas, December 20th, for symptomatic obstructive hypertrophic cardiomyopathy.
Which is, for listeners who don't know, it's a genetic heart condition. The heart muscle thickens, making it harder to pump blood.
So Mycorrhiza's approval basically creates a duopoly overnight. It's now competing head-to-head with BMS's established drug, Camzyos.
And that's in a market estimated to be worth, what, $3 to $5 billion? It's huge.
In any duopoly, though, differentiation is everything. So how does a company like Cytokinetics expect to take market share from a giant like BMS?
This comes right back to our efficiency theme. It's all about dosing convenience.
Dosing convenience?
Yeah. The current standard, Camzyos, requires really frequent and complex heart monitoring echocardiograms because of side effect risks. Mycorrhiza is expected to require much less frequent monitoring.
And that's really enough to move the needle for doctors. Just less monitoring.
It's a game changer. It speaks directly to that efficiency rotation. For a cardiologist, it means less paperwork, less risk management, and higher patient throughput. It just makes their whole practice more efficient.
So the Q1 catalyst is the launch itself. First prescriptions filled in January 2026. And we'll get the first signals from that and then updates at the JPM conference in February.
Right. And the sources are targeting $150 to $175 if they execute well. It's a core holding, but with that immediate launch risk baked in.
Okay, let's move to the second core holding, which is all about synergy. We're talking about BioMarin Pharmaceutical, or BMRN.
This is a classic rare disease consolidation play.
But what's the real value driver here? It's more than just mashing 2 companies together, right?
Oh, it's all about the synergy realization. BioMarin's $4.8 billion acquisition of Amicus creates this truly dominant force in enzyme replacement therapy. They're combining Amicus's Pompe drug with their own Fabry and MPS franchises.
And the financial nugget is that this synergy isn't just speculative, it's quantifiable. Exactly. They are targeting $150 to $200 million in annual synergies.
Wow. And where does that money come from?
Mostly from consolidating their global sales forces and optimizing manufacturing. That alone is expected to boost their operating margins from the low 20s up to the mid-20s by 2027.
So that margin expansion is what underpins the whole thesis. And we see the catalyst right away in Q1.
Yes. The consolidation plans roll out in January and February, and you'll see the first hard numbers on those synergies in their March earnings report. That steady, predictable growth is why it's a core holding.
Now we shift from pure execution to these bigger structural forces. The next picks are about capturing these global secular tailwinds.
Right. These are plays driven by major policy shifts, which, often isolates them from the typical binary risk of a clinical trial failure.
And that brings us directly to the ultimate security at all costs play, Samsung Biologics,
This stock is a direct beneficiary of the BIOSECURE Act.
which is the U.S. legislation that's forcing pharma supply chains to decouple from Chinese manufacturers like WuXi Biologics.
Exactly. And the question became, well, where does all that manufacturing work go?
And Samsung, a Korean company, is positioned to just catch it all. What's the quantifiable size of that opportunity?
The sources estimate Samsung could capture a staggering $3 to $5 billion annually just from programs moving away from China. They already have massive capacity, 620,000 liters, and they're expanding to 800,000.
So that sudden demand must be creating a huge bottleneck for the whole industry.
It is. The scarcity is so acute that the sources are confirming Samsung now has a 2-3 year booking wait list for new contracts.
A 2-year wait just to get your drug into the manufacturing queue?
Think about that. And that wait list gives them immense pricing power. They're pushing through 10-20% price increases, driving their margins from 28% up toward 30-32%.
And the Q1 catalyst here would be seeing those new contracts announced.
That's the proof. Seeing big pharma companies announce they're moving programs from WuXi directly to Samsung is a very defensive growth play.
So if Samsung is solving the security problem, our next pick, Halozyme Therapeutics, ticker HANGLALO, is solving the logistics problem. This just screams efficiency rotation.
It really does. Halozyme basically monetizes the subcutaneous, or SC, delivery megatrend with their enhanced platform.
So to put it simply, they have a technology that lets you take a drug that normally requires a long, slow IV infusion
And delivered as a quick injection right under the skin.
That's a huge quality of life improvement. You go from hours in an infusion center to a quick shot. It's like turning a trip to the DMV into a drive-through.
That's a perfect way to put it. And it's a capital-light royalty play. Halozyme isn't developing the drugs. They're just collecting royalties from partners like J&J and Roche for using their delivery tech.
So their growth is baked in as their partners' drugs succeed, but Halozyme doesn't have to take on the R&D risk.
That is the beauty of this model. That royalty stream is forecast to jump from around $300 million in 2025 to maybe $500-700 million by 2028. It's a huge win for the efficiency theme.
And yet, what's fascinating is the company trades at a discount, around 12x forward earnings, despite that low-risk growth. The target of $75 to $85 is supported by that royalty stream kicking into high gear.
Okay, now let's turn the corner to the most exciting and maybe nerve-wracking part of the portfolio, the tactical, high-risk, high-reward plays.
This is where that position sizing discipline becomes absolutely non-negotiable.
And the highest risk binary play in the whole playbook is Viking Therapeutics, or VKTX. This is the obesity challenger.
The whole bet here is on their oral GLP-1 drug, VK2735. The obesity market is potentially the largest in history, but the bar for entry is incredibly high.
Because of the massive efficacy we've seen from injectables like Wegovy and Zepbound.
Exactly. So the make-or-break event is the March 2026 Phase 2b data. To even compete with Novo and Lilly, Viking's pill has to show weight loss that's comparable to the injectables.
What's the number? What do they have to hit?
We're talking 15% to 20% total body weight loss at 6 months. Anything less than that, and it's basically irrelevant. So that's the binary switch. If they hit 15% or more, with good safety,
they instantly become a massive M&A target. The stock could go to $100, $130 a share, a 50 to 100% return.
But if they miss, if it's, say, 10% weight loss or the side effects are bad,
then the stock plummets to $30 or $40. It's a clear 2-to-1 or 3-to-1 reward risk scenario, which is why the sources stress a max 3-5% allocation. You have to be willing to lose it.
Okay, our second tactical pick is a bit different. Insmed, ticker INSM, which is framed as an oversold quality recovery.
Right. This one has a slightly longer fuse, but it's a compelling setup for a contrarian.
So Insmed had a brutal sell-off in December. They dropped almost 16% after a trial failure.
A massive overreaction. The market completely missed the point. The contrarian view is that the news was fundamentally immaterial to the company's core value.
Why was it immaterial?
Because the core value driver, their drug brensocatib for bronchiectasis, is completely intact. And that indication has a peak sales potential of $2 to $3 billion. The failure was in a peripheral area.
And they have an existing drug, Arikayce, that brings in over $400 million a year.
Which provides a solid cash floor. that cash funds their operations until the really important data comes out.
So they have time.
They have time. The key catalyst is the ACE-Penstavan Phase 3 data in the second half of 2026. So the stock's current price, around $62, is seen as a tactical entry point at a discount, with a target of $80 to $90 if that data is positive.
To balance all of that risk, though, we need a defensive anchor, a large cap that provides some ballast.
Exactly. And one large cap stands out because of a specific policy catalyst, Merck, ticker MRK.
This sounds like a re-rating opportunity driven entirely by the removal of political uncertainty.
That's precisely what it is. The policy nugget is the Trump RX Accord, which gave Merck a specific 3-year tariff exemption.
Right.
That policy risk had been compressing Merck's valuation, keeping its PE around 18x instead of its historical 22x to 25x range.
So removing that risk premium lets the stock breathe, essentially.
It removes the discount, and we can actually quantify it. The exemption is expected to save them $1 to $1.5 billion in annual tariff costs.
Which translates to what for earnings per share?
About several dollars and 20 cents and 30 cents added to their EPS. It's a direct, quantifiable benefit.
Plus, their main engine, Keytruda, is still protected for a few more years.
Absolutely. Keytruda's $25 billion in sales is safe until 2028, which gives them a long runway for their pipeline to mature. The Q1 catalyst is the February 2026 earnings report, where they'll quantify that tariff benefit, supporting a move toward the $120, $130 target.
So summarizing this deep dive, the Q1 playbook is really about structure. It's balancing stability from Merck and BioMarin with thematic growth from Samsung and Halozyme.
And then taking on some calculated asymmetric risk with Viking and Insmed.
And what we need to reiterate for you, the listener, is that the success here is less about picking the one right stock and more about discipline.
Precisely. The whole framework demands it. We're talking about strict allocation rules. No single position over 10%, keeping those binary plays like Viking under 5%, and using stop losses to protect your capital.
That discipline is what lets you survive the volatility. And what really stands out across all 7 of these picks is that the market is rewarding security and efficiency above all else right now.
It really is. Commercial logistics, supply chain safety, better drug formulation, those are the dominant themes. It's a huge pivot away from purely speculative science.
And the Q1 calendar is just packed. You've got the Cytokinetics launch in January, Merck's earnings, and that Trump RX clarity in February, and then the huge high-stakes Viking data in March.
And that concentrated calendar leads to a final provocative thought for you to mull over. If the sources are right and supply chain security is now at all costs, and we know Samsung has a 2 to 3 year wait list for manufacturing capacity, what does it mean for the entire pharma development lifecycle when just securing a manufacturing slot becomes a multi-year bottleneck, even for the biggest companies in the world?
That structural constraint is something that's going to reshape this industry for years to come.